What's up you guys, this is Chris for Hustle and Bustle. You wanna know why I'm so excited about real estate? Today we're gonna talk about the 5 tax benefits that come with real estate. And if you wanna learn how to create wealth without all the hype, maybe you should stick around till the end of the video and learn more about it. After all financially rich people own real estate, and that shouldn't be a coincidence, right? If you're new to this channel, here I talk about finances and creating wealth. So if this is something that interests you, stick around and consider subscribing. Now let's talk about the 5 tax benefits that I prepared for you today. There are more than that, but I just chose those 5 to present to you today. Now the first one is deductions. Now before we start, I want to mention that all we talk about on this tax benefits is for investment properties, not for primary properties or vacation properties. They are usually a little bit different. There are deductions for them or other tax benefits for them, but today we want to talk about only for investment properties. And number 1 is deductions, like I already mentioned it. One of the most basic tax benefits to owning real estate is deducting certain expenses. Those may include property tax, property insurance, mortgage interest, property management fees, advertising expenses if you have any, property repairs, capital improvements, or ongoing maintenance. If you decided to invest in real estate via LLC, not as your personal name, then you can add to those expenses, to those deductions, other stuff like attorney's fees, accountant's fees, office space such as home office, like this here is my home office, travel expenses such as traveling to and from your real estate of your house, not your house, but your rental. Also, if you're going to look for new properties, you can write off the mileage. If you bought any course for educational purposes or membership fees that you might have connected to that real estate business, that's also one deduction. If I'm not mistaken, they brought back the meals after COVID. They're trying to stimulate the restaurant industry. So if I'm not mistaken, I am 95% sure that meals are deductible for the past few months at least. Advertising and marketing expenses such as mailers for finding off-market leads, business cards, sign for your office, and so on and so forth. Business equipment such as a laptop like this PC that I'm using and my laptop. It's all business expense. This microphone is business expense. Unfortunately, the camera is not, because I did not have the business at the time that I bought the camera. But all those things, phone lines, they're all deductions. And with the travel expenses, even tickets, if you go to Miami to check out the property, this is a travel expense. The rule is that 51% of the time you need to be conducting business. And if 51% of the time you are conducting business, this is considered a business deduction or business expense. Obviously, don't trust the guy on the internet. Talk to your CPA. They will tell you even more things that you can save on eventually, hopefully. Now, the next tax benefit is depreciation. Now, before we go to the next one, please help me support the channel and smash the like button for the YouTube algorithm. So if you own a property that is used for business or income producing purposes such as rentals for 1 year or more, you can depreciate the value over time. We've already talked about those things on in my other videos. If you don't know where to look for my other videos, I'm going to include a link right here where you can see all of my playlists that I've had all of my real estate videos there. But residential properties depreciate over 27.5 years and commercial properties depreciate over 39 years. The next tax benefit, number 3, capital gains tax instead of income tax. So basically, if you hold the property for over 1 year and 1 day and you decide to sell it, you'll be hit not with an income tax from the profit. Hopefully it's on a profit, most likely to be on a profit, but you'll be hit with a long-term capital gains tax, which will range between 0 and 20%. In my last video, we actually showed the different brackets and how they work. But basically, income tax is one of the highest tax paid. The taxpayers pay the most amount of money. If you don't know that yet, maybe next video I'm going to do the quadrant where I'll show you how the regular person who pays income tax pays the most. Then the next one is the self-employed who pays also the most but less than the regular person. Then we got small business, and then we got big business. And can you guess who pays the most amount of tax? That's a different topic, but there's actually logic, there's a method to that madness. There's a reason for that. But let's continue with the video. So reason number 3 is that when you sell the property, if you keep it for more than 1 year and 1 day, you're gonna get hit with long-term capital gains tax. Now, if you sell it before that, it will be short-term capital gains tax, and the tax there, to my knowledge, is somewhere between 10 and 37%, which is not ideal. This is pretty much your regular income tax. So keep it for more than 1 year and 1 day. Now, you can utilize some tax deferred or tax-free methods of investing in real estate to avoid paying those capital gains tax. And those methods are, like we spoke in other videos. Tax benefit number 4 for investing in real estate is 1031 exchange, which I've talked extensively in that video. I explained what it is, maybe more in depth than you need, because that video really bombed. People didn't want to watch it, or maybe just specific people wanted to watch that video, but it's not very entertaining, but it's very informative. So watch it, guys, right there. I'm going to link it also down below. Section 1031 from the IRS code. It allows the real estate investors to swap their property for a like-kind property, thereby avoiding capital gains tax or recapture, thereby avoiding to pay capital gains tax or depreciation recapture at the sale of the property. And the final tax benefit that I want to present to this video, although like I said there are many more, is something called the live-in flip. So flipping and rehabbing are not the same, but the live-in flip is a strategy that exists somewhere in between those two. You could end up paying zero capital gains tax on a property that earns up to $250,000 for a single filer, or $500,000 for couples or married couples filing jointly. Qualifying for Section 121, which means you must live in the property. That must be your primary residence. You have to own the property for 2 out of the last 5 years. So what essentially that means is you can buy a house, and for 2 years, that's your 2-year plan, you fix and improve the house. You might buy a house, you gotta find a house that is livable so the bank can actually loan you money, because banks do not loan money, they do not write mortgages on tear down properties. It needs to be livable. So you move into the house, something like this. Although this is pretty good, it did not need a lot of repair, but it did need improvements. For example, on this house, we've changed one of the bathrooms. I'm planning to redo all the floors. I am planning to redo the whole kitchen. And on other houses, maybe there's other improvements to be made. Maybe the roof needs to be changed, maybe the windows going to be changed. So in those 2 years, maybe you're a handyman, or you're going to learn to become a handyman, and you're going to change a few things. Say you buy the house for $120,000, you do all those improvements, maybe they're gonna cost you $30,000 because you're gonna be doing them. And on your personal primary property, you do not need a licensed contractor, nor you do need to pull permits. So after 2 years, you've improved the house for $30,000. So everything is $150, right? I mean, you didn't really buy it outright, you have a mortgage, but all in you're $150. Now say you sell the house for $250,000, $280,000, whatever. The market appreciated, you brought the house up. Maybe the houses in the neighborhood were all renovated and they were worth $200,000, but yours was the only one not renovated. So you brought it up to the renovation after repair value. And now the house is $220 with a little appreciation. So now when you sell the house, you bought it for $120, now you're selling it for $220. $100,000 is something that you made in equity. And now, because you live 2 years, you do not owe any taxes, not $100,000, they're tax-free. So that's in kind of a simple example how that works. You can also qualify for partial exclusion if you have to relocate for a job, unforeseen circumstances, military deployment. That can qualify you for partial exclusion for paying taxes. There are more things we can talk about, guys, but that's all the time we have for today, and that's all the topics we picked. We can always talk about pass-through deduction or opportunity zones or Section 8 tenants or what have you, but this is gonna be the video for today. Thank you very much for sticking till the end, guys. If you already hit the like button, I appreciate you. I'm trying to grow the channel for maybe 200 subscribers till the end of the month of July. Hopefully we reach that target. We're sitting at about 150 now, so please help me grow the channel, and thank you very much for your support. Keep hustling, guys, and I'll see you next time.